Hey everyone, this is a short video on my 3 ways to identify a trend. Trend analysis is one of the most important areas of technical analysis and is key to determining the overall direction of a currency or a stock. While it can be challenging to identify the trend direction, but once you identify the trend, it can make your trading a lot more simpler. Here is an example of a typical Forex market. A downtrend is followed by a pullback, and there is market consolidation before the downtrend continues. The trends are based on the principle of higher highs, higher lows in case of an uptrend, and lower highs and lower lows in case of a downtrend. Understandably, trends can look different if you open up a chart for a different time frames. Hence, it's important to note that the trend is relative to the time frame you're looking at. A weekly chart may show an uptrend. However, if you open a daily chart, the trend may look like the security is moving down, while the 4-hour chart may indicate that the market is moving up. Hence, multiple time frame analysis helps the trader understand the bigger picture better. So, here are my 3 ways on how to identify the trend. First, identifying higher highs and higher lows in case of an uptrend, and lower highs and lower lows in case of a downtrend. Identifying higher highs and higher lows is one of the most fundamental price action patterns used by traders and can be used on any time frame and any market. Whenever you want to identify a trend, you first need to pay attention to the time frame you want to trade in. I always begin with the daily chart or sometimes a weekly chart, since the larger time frames gives a more balanced view of the market. To understand the concepts of higher highs and higher lows, let's take a look at this picture. As you can see, the price first moves up and then pulls back, then again it returns to the upside and breaks the recent previous highs. In this case, all the highs are higher than the previous highs and the market has not gone below the previous lows. And all the lows are higher than the previous lows and the market has not gone below the previous lows. Similarly, in this case, the price moves down and then pulls back. Then again it starts going down and breaks the previous low, thus making a new recent low. Even in this case, the highs are lower than the previous highs and all the lows are lower than the previous lows. Let's take a look at the US dollar JPY daily chart. In this chart, you can see the trend is changing from the previous downtrend by forming a higher highs and higher lows. Similarly, in this example of the of the Aussie US dollar daily chart, you can see the trend is moving downwards since we have lower highs and lower lows. When you consistently see this pattern over a period of time, then you can identify the trend direction better. Further, it's always recommended to check this pattern on multiple time frames so you have a better understanding of the direction of the trend. The next trend identification method I want to talk to you about is the moving averages. Moving average is one of the most popular trading tools to identify the market trend. In the case of moving average, if the moving average is below the candlesticks, then it means the market is in an uptrend for that period. And conversely, if the moving average is above the candlesticks, it means the market is in a downtrend for that period. In this example, you can see that I've installed a 200 simple moving average on the Euro USD chart. And as you can see, first we have an uptrend since the moving average is below the candlesticks, and then the trend changes to a downtrend since the moving average is above the candlesticks. Many traders use different moving averages on their charts. Some use fast moving average, which might give a lot of early signals because it reacts too soon to minor price movements. On the other hand, a fast moving average can get you out early and when the trend is about to change. In this Aussie US dollar chart, I've installed 3 simple moving averages: 5, 50, and 200. This one is the 200 simple moving average. The purple one is the 50 SMA, and this one is the 5 SMA. As you can see, the faster moving averages, which is 5 and 50, react so quickly to price change. And a lot of time it gives a false signal of the change in trend. Have a look at this cluster. The trend in this case is changing almost every day. And you will never know the true trend of the currency. However, the 200 SMA in this example consistently gives you the direction of the trend as a downtrend. A slow moving average might provide signals late. However, it can help you filter out the noise and provide a more stable view of the current market. Like many traders, I like to use the 200 SMA on my charts as it helps me make better decisions. In order to have a better understanding of the trend, it's always good to view the trend in multiple time frames. Hence, I always start the chart Hence, I always start with a daily chart and then the 4-hour chart, and then I use the 1-hour chart. If all three time frames indicate similarities in trend based on the moving average, then I conclude the direction of the trend. If you see this example, in this example, you will see that for the daily 4-hour and the 1-hour chart, the simple moving average is below the candlesticks. The trend is up, so I will only be looking at the buy trades. Similarly, in this example, you can see the 200 simple moving average is above the candlesticks for the daily, 4-hour, and the 1-hour time frame, which indicates the trend is down and it's a good time to look for selling the currency. Another way to identify a trend is to draw trend lines. Trend lines are another way of identifying the direction of a trend, and they also help you understand the markets better. A trend line is one of the basic components of most technical analysis. To construct a trend line, you need to simply connect the higher prices or lower prices on a chart. The resulting line is the trend line. An uptrend is formed by connecting the low prices of the currency or any asset you are trading where the most recent low prices is higher than the previous low prices. Similarly, the downtrend is formed by connecting the high prices of the currency. I personally don't use trend lines very often, but whenever I do, I use it to identify changes of an established trend. For example, if you have a strong trend and suddenly the trend line breaks, it can signal the transition into a new trend. It's like if it breaks this area, then I would consider it to be a change in the trend. So those are my three ways of identifying trend. As I mentioned earlier, I'll teach you one simple strategy of mine which I have used very consistently over a period of time, and that is with moving averages. Let's take a look at this example. The gold to US dollar chart on the daily shows an uptrend based on the 200 SMA that I'm using. Similarly, the 4-hour chart is also in an uptrend, and the 1-hour chart also indicates an uptrend. Now, in this gold to US dollar chart, we have established that the trend is up, so I will only be looking for a buy trade. I will not go in for a sell trade simply because the gold to US dollar is in an uptrend and I always like to trade in the direction of the trend. So I have a higher probability of success. So in order to enter a trade, I will open up my 4-hour chart and look for the nearest support area, which in this case is right here. Cause it's likely that the market will bounce back from this area, I will be looking at this point as an entry point. I will put my stop loss slightly below the next nearest support area, which is at this point around here, and my profit target will be at the next resistance level, which is in this area, thus giving me almost a good 3:1 profit target. So that's it, guys. I hope this was useful, and please be safe in your trading strategies. If you like this video, please give me a thumbs up and subscribe. Thank you.